I just wanted to jump in and ask about, like, my association in my head. I have the higher the risk, typically. I mean, the higher the yield, typically the higher the risk the asset is in terms of tenants. Is that a general good rule of thumb, or is it just like not good to think about that way?
Yes and no. So yes, when you get to the high end of the spectrum, like in this market, anything you buy above 7.5% net yield, there is a reason for that. Like you're either going quite regional in a high vacancy rate area, or the tenant's not strong and things like that. The no answer of it is it depends what you consider high risk. So like an example I use is let's say $1 million property. So say we want to buy $1 million warehouse. We can look in Sydney and we can go by, let's say in the inner ring, so inner west, like an Alexandria or something like that. We can go buy a warehouse there at say a 4% net yield, and it's got tight vacancy rates, good tenancies, things like that. And it's going to be a little warehouse. It's going to be like 60 square meters max at that kind of price point. So is that more high risk than say buying in a different market like Brisbane, where we can get a 6% net yield, where the vacancy rates instead of being like a week or two might be a month? Because for me, like that difference in 2% is also a buffer, because we're literally getting a third more rent. We can have a third more vacancy and actually be in the same financial position. So it's kind of balancing that. So certain markets, it's the same argument for like residential. When someone goes, oh, what's lower risk, a $2 million house in Sydney or a 600K house in Brisbane or Perth? There's a pro and a con. You need to kind of assess why you're buying. Here's the secret. They all actually grow the same over the long term anyway. It's just out of different cycles if you buy the fundamentals correct. But the whole point of investing is obviously trying to, especially with commercial, get a cash flow return, but still get that capital growth so you win on both fronts.
It sounds like this is obviously my feedback from my path of work as well, is that people are so short-term focused, but they're investing for the long term. And it's because of that they're not, I guess, looking at that bigger picture. Is that obviously the same that you're seeing in commercial side of things as well?
Yeah, it's hard because the type of clients I attract obviously are gravitating towards my strategy. And like I see both ends of the spectrum. Like I get clients that are like, must be 7% net yield, have value add. They're the kind of aggressive kind of ones. Then I get like the Sydney, Melbourne clients who actually just think they're like, oh, if I buy in Sydney or Melbourne at 4%, that's going to be really low risk because long term it's a stable performer. And it is in some regards. But like I said, what's like that one also has to grow more just to make up the yield difference. So it just depends what your strategy is. But exactly what you said, I always buy to about 10-year mindset. Like I try to predict 5 years for clients, because if I can get them capital growth in the next 5 years, then they do well. But anyone talking, oh, this property is going to go off in the next 2 years, like the conversation I had yesterday, the Olympics just keeps popping up. People keep going, oh, the Olympics, it's going to perform really well. And I'm like, yeah, it's a great 20-year indicator. And they're like, no, like next couple of years it'll boom. And I'm like, you might get a small spike from investor interest, but fundamentally the infrastructure going in doesn't mean it grows now. Like they put the infrastructure in. The key with like Olympics is the infrastructure they put in gives it the ability to actually grow in 5 years' time, because they've got the train lines, the buses, the stadiums, the apartment blocks and things like that. That lets them come. And as someone who grew up during the 2000 Sydney Olympics, I can tell you after the Olympics, Sydney Olympic Park was ghost town for about 5 years. And now it's filled up. It's actually quite a nice area. There's cool restaurants and transport and things like that. But it's just a good indicator. And that's a macro driver. You're looking at, okay, what's this area going to do in 20 years' time? But if you're trying to plan for the next 5 years, you have to look at the numbers now.
Yeah, that makes complete sense to me. Like with the different yields, would you say like Sydney markets and Melbourne, they're generally a tighter yields? Is that sort of like a leading indicator to see where, say, Brisbane could go? Do you look down that sort of that route?
Yes and no. In saying that though, I'm still buying quite a lot in Sydney, for instance. Like I've purchased like 3 or 4 in the last month in different areas, and they're still quite good yields. Like some of the areas have softened. Like we bought a couple on the northern beaches at 6% yield, and you're like, well, this is kind of brilliant. We're getting there. It's the same argument as residential. No one actually knows. I look at like demand, basically supply versus demand. If there's more people looking for that type of premise, that's either going to equate to rental growth or capital growth. And what's better, like the Northern Beaches ones where we're buying it at a 0% vacancy rate versus an area with a few high percent yield with a 0.5% vacancy rate. Like which one's going to be the leading indicator? But that's why I generally try to buy stuff that's surrounded by residential property. So they're not releasing any more stock. and then looking at like population growth is a pretty good indicator for demand. Like if the population is set to double in the next 10 years, let's say 30 to 40% increase, how are we going to have less demand for a warehouse or a medical center or a cafe? So it's just trying to match up that. But long term, if you keep those fundamentals, you'll keep the tenant, you'll keep the rental increases, you get the capital growth, it'll perform really well for you.